Hey guys, welcome to the show. This is live live stream on Monday nights with Kevin Burgess. If you don't know who I am and you're watching this on a let's say a delayed broadcast, then my name's Kevin Burgess. What we talk about on this channel are dividend stocks, and so tonight is live stream. It's about whatever we want to talk about. So I'm going to actually kick off in a few minutes here with a definition of CAGR, which is compound annual growth rate, a very important metric for dividend growth investors. But before I do that, before I kind of kick that off, I wanted to share some news with you guys today that maybe you didn't see. And actually, I have to pull it up. So let me do that. I'm going to share my screen here. And we are going to pull up Simply Safe Dividends. You can see that here on the screen. Whoops, you don't want to see me. There you go. So looking at Medtronic. Now, I happen to own a few shares of Medtronic. I started a position in Medtronic, but I decided to hold off and see kind of where their product line went, and so it was an interesting article today from Simply Safe Dividends, and well, we'll just kind of chat through this a little bit. I'll try to make this a little bigger so you can see it. So Medtronic is they're rated a very safe dividend, a 99, the highest rating that Simply Safe Dividends has. They reaffirmed that today and had a write-up that I thought was very helpful. So I thought, since we're doing the live stream today, what a perfect opportunity to share this with you guys just for showing up for the live stream. This is really good stuff. So it kind of starts out by saying, hey, Medtronic has lost more than 30% over the past 2 years. And so I think we kind of knew that. They show them as being undervalued. They got a high dividend yield. Their payout ratio, their PE ratio is lower than it's been in a long time. They are 15 versus their healthcare group at 16.4. They're in the middle of their 52-week price range. They're down around 79. They've been up as far as 91, but as low as looks like 69.43. So, but here's some things that they pointed out, and I thought I would just share these. I'm not going to read this whole article with you. I will kind of scroll through it. So if you want to catch it on watch it again later, you can, kind of stop the video. But it basically lays out some of the issues that Medtronic has had. And then they come around and they say, well, the Medtronic's adjusted operating margin also ticked higher. They're talking really about the third quarter. I'm going to get down here where you guys can see my cursor. There we go. There it is. So they got some breakthrough drug. Well, they don't have. There are some breakthrough drugs that are dealing with things like, type 2 diabetes and things like that. And so there is some concern that would impact the need for some of Medtronic's products. They go through some dissertation here around what they think is going to happen. And they basically are saying that it is time really to begin considering reinvesting in Medtronic. So I'm just going to kind of flip through this article, but they say at the end they'll continue to monitor it. But it has been very helpful to kind of see where Simply Safe Dividends is coming in on this. And so because of that, let's just pull up. Let's pull up my position in, maybe I can do this. We'll look at it in Morningstar because I do want to share what the Morningstar information is. Let's just pull up Medtronic in Morningstar. Sometimes it doesn't work as well as it needs to. So there it is, Medtronic. So $79 is where it closed out. The interesting thing about Medtronic is they have a fair value of around $112. So they're roughly 29% discount. They're trading at 79. They're a 5-star stock according to Morningstar. They have a wide economic moat, and a standard capital allocation. So yeah, I think there's a lot to like about Medtronic. I think I own 150 shares. Well, let's go look. We'll pull up the old portfolio here, and I've got it set to my benchmarks at the moment, but let's flip on over and go pick up Medtronic. You can see Medtronic is here, and yeah, 153.906. It is set to reinvest the dividends. So, but it is less than 1% of my portfolio. I've still got a lot of room to grow that. So I am considering, guys, adding to the position in Medtronic. I know that I put a video out this weekend. I didn't even mention Medtronic, but sometimes things change. So I thought I would share that with you guys today or tonight on the live stream. So you're hearing it here first. So it's great to be with you guys tonight. I am looking forward to this broadcast, and I'm looking forward to talking about compound annual growth rate as well. So, but before I do that, let me see who all's on the stream here tonight. We've got Jim Betts. Welcome, Jim. We've got another Kevin in the house. There's 2 Kevins, so you just really can't beat that to have 2 Kevins in the same spot. And there's Jim again. Now we got Billy. Billy's from from across the world is joining us. It's morning, I think, for him, evening for us. Got my buddy Ryan Williams in the house. Welcome, Ryan. Great to have you here. And I think it was a weird day in the market, at least for me. So we got James Andrassi. It's good, James, to have you here. Appreciate you showing up. Charles Rivers, welcome, Charles. Good to have you here. Let's see if I can find a few more. Thomas Roach, welcome back, Thomas. You were here last week. I appreciate you coming back this week. We have Gregory Pawlowski. Sorry, buddy. I'm trying my best. Pawlowski. I think that's it. But let me know if I get that wrong. And we have El Dynamico. That's an easy one to say. So El Dynamico. So, okay, well, let's get started with the compound annual growth rate. I'm going to share that on the screen here for you. And I think it'll be kind of interesting. At least it was for me as I was putting it together. I'm going to stop sharing that one, and I'm going to start sharing this one. And hit that. Okay, I think we're ready to roll. I'm going to take El Dynamico off the screen. Actually, I want to take me off the screen as well so that you can see this whole thing. So let's talk about compound annual growth rate. It's extremely important for dividend investors. So let's go through. Oops, I made it a little bigger so you guys could see it, but now it takes me a little while to scroll through one of the slides. So I found this to be interesting. The definition, according to Investopedia, is that CAGR, and that's the way you pronounce it, is CAGR. But this is what I found to be interesting is they have it pronounced CAGR. So CAGR. But I think it's really pronounced CAGR. It's a lot more fun to say it that way. The compound annual growth rate is the rate of return that would be required for an investment to grow from its beginning balance to its ending balance, assuming the profits were reinvested at the beginning or at the end of each period of the investment's lifespan. And, guys, that's kind of boring. So let's look at it a little differently. I'm going to move to another slide, and let's talk about some pieces of this. Why do they name it what they named it? So compound means that it assumes there is reinvestment. So when you say compound, it means that there is a compounding that is occurring. That means that it is getting reinvested every period. So let's look at an example of this. I have a very simple example. Let's say that the beginning dividend was $1. You see that here on the far left, $1. And let's say that this particular company increased its dividend by 10% every year. You see that here. The growth is 10%, 10%, 10%, 10%. And so the first year, 10% of $1 is clearly 10 cents. So that means at the end of year one, they would have increased from $1 to $1.10. However, in year two, a 10% increase is not 10 cents anymore because you now have $1.10. So 10% of $1.10 actually gets you now to 121 instead of what you would think of normally as 120. So, and then in year three, it goes to 133, year four, 146. Ultimately, in year five, we get to $1.61. That is a 10% CAGR over a 5-year period. So that's kind of cool. But let's take a look at one other example. We're going to look at this second example here, and we're starting again with $1. But this particular company that we're looking at, company B here, grew by 15%. So at the end of year one, they didn't have $1.10. They had $1.15. But then in year two, they fell in a little hard times. They went down to 3% increase. So now they're at 118. They fell behind company A. Then in year three, they went 4% and went to 123. Year four, they jumped by 20% at 148. But in year five, they ended up with 161 and they increased their dividend by 9%. The interesting thing to point out here is that their 5-year CAGR would be exactly the same as the one who increased their dividend by 10% every year, because they started at $1, they ended at $1.61. That is a 10% average annual compound growth rate. So thought that might be a helpful explanation. You might have to, rewind this and watch it a couple of times, but it's important to remember when we're looking at 5-year CAGRs for our dividend growth stocks, these dividend growth numbers can move around, and it looks like they're the same stock, but they act totally different. So let's look at one other thing here. Annual. So, compound was about it compounding. The annual part of CAGR, compound annual, means that it's expressed in annual terms. So every time you see CAGR, it is going to be on an annual basis. Growth means that it is about dividend growth. We, as dividend growth investors, look for these growing sweet dividends. We love to see those. And then the rate is expressed as a percentage. It's really kind of a rate of return. So if we really named this with everything we should have in it, it would be the compound average annual growth rate of return. So it would be like CAGR, but yeah, we just say CAGR. So I thought it'd be interesting then to look at a couple of examples. So this is going to be a bit of a quiz in tonight's broadcast. So let's take a look at this right here. You see example A. This is a real company, and I'm going to put me back on the screen because I love to see myself on YouTube. Let me do that. There I am. Hey, guys. So example A is a real company. The latest dividend increase was at 5.3%. The last 5-year CAGR, their 5-year average, is 6%. And over 20 years, they have a 9%. So tonight, you get to guess which stock this is. It is, I will give you a hint, it is a stock that is in my portfolio, and I have done a few videos on this stock. It is not some stock that is real nebulous and not out there, but I want to see if you guys can guess what stock this is. Which stock would have this straight a line of dividend growth over a 20-year period of time, 2003 to 2022. And so we have one guess out there so far. Everybody else is a little scared. So we have Dresh with J&J. That's a great guess. Miguel says SWK. That's a good guess too. Any other guesses out there? I don't see any more. Everybody's a little scared. GGG, that's a good guess too, Greg. Lowe's. Wow, this is good. Oh, Tattooed Chef. I didn't think about them, but that's a great guess. But no, that's not it. So Miguel also thinks GGG. So I will spill the beans. Let's see. Captain Suburbia is in the house. Welcome, Captain. So he says, Mo, he said he feels like Altria Group has been higher over the past 5 years, but I don't know. So I would say that this particular stock is Johnson & Johnson. It is Johnson & Johnson. They have grown their dividend. I mean, look at this line. You don't find this line just anywhere in any company. I mean, that is a pretty straight up, well, it's not straight up, but it's a very consistent slope. So that is Johnson & Johnson. But you know what? You get another shot at this because I'm going to show you one more. There's one more, and it is example B. And if you'll notice, it has, oops, I got to take Captain off of the screen. So if you'll notice, I had to hide the ticker. And so, one hint is that it is also in my portfolio, and I've also included it on a dividend video here recently. And it is a fiscal year different than January to December. You'll notice that they are July to June. I didn't know that until I actually put this slide together. So I don't know if that's a great hint, but so who do you think this is? You'll notice that this one is a little more rocky. It has some higher growth periods, some lower growth periods. And then here recently, over the last couple of years, they've grown significantly. The latest one was 11%. That was in April. They've got a 15% CAGR. They're growing their dividend by 15% on an annual basis, which is really phenomenal. All right, so what guesses do we have? We have Coca-Cola, Hershey, Microsoft. These are all good guesses, and to be honest with you, I don't know how anybody would get it. I'm really excited that Dresch got Johnson & Johnson. Captain Suburbia says Texas Instruments. Those are all good guesses. Vici from Jim. Costco from Dresch. We have Pepsi from Paul. And we have PH, Parker Hannifin from Gregory. That's a great guess. CMI is another good one. Air Products, that's a good guess. They would probably have a very similar one, but that's not it. And the answer is actually, Greg got it. It is Parker Hannifin. This is Parker Hannifin's CAGR. So it's important to notice that I'll flip back to Johnson & Johnson. See, Johnson & Johnson has a slower 5-year CAGR at 6%, but it is very consistent. That means they're growing that dividend every year consistently, whereas Parker Hannifin is a bit more rocky, but man, look at that 15% growth in dividend. So that's kind of exciting. So let's take a look then at the next slide. I'll get my cursor over here. So why is CAGR important? So the question I used to ask when I was in my job, when somebody would bring me some data like that, I would say, so what? What is it trying to tell me? So what? Well, so what is that it measures, this CAGR measures the dividend growth over a period of time. And that can be either 1 year, 5 year, 10 year, 20 year. You can pick whichever one you want to look at, or you can look at all of them. I choose to look mainly at the 5-year dividend CAGR. Why is that? It's because it's not so long that it's I guess that it would be related to old news, right? That if I went to 10-year, maybe there's some stuff from 10 years ago that I don't even know anything about that's kind of clouding those numbers. So it's not so long that it's out of the realm of possibility for the current period of time. And it's not so short that it causes me to think, good or bad, depending on whether they've had a good year or a bad year from a dividend growth perspective. So it gives me a bit of I don't know, 5 years just seems to be a good number for me to look at. But then I use that 5 year to compare every company that I look at. So, but here's another thing is that it could mean that the business is performing well. Why do I say it could mean that? It doesn't always mean that. And if you want to and you need something to kind of put you to sleep at night, the NyQuil's not working, Sominex is not working. I've got a couple of videos that I think will help you. And one of those videos I did on Pepsi. So just search for Pepsi in my videos, and you'll see that Pepsi has been consistently raising dividends, but they have been borrowing the money to do it, and that made me uncomfortable with Pepsi. Although this past quarter, I will say that I did look at their cash flow statement this past quarter. They do look better, so it looks like they're coming out of the woods on that. But for quite a long period of time, they have been borrowing the money to not only raise, but to pay the dividend. So it made me a little bit nervous on Pepsi. So I moved on from them. Another one that you can look for is it's a car care company. I think it's Advanced Auto Parts. So take a look at those videos, and I think those will kind of help you see what I'm talking about here. Just because a company raises their dividend doesn't mean the business is healthy. So it is important that we understand that there's not one metric that we as dividend growth investors look at. We look at a myriad of metrics to make sure that they're not pulling levers and causing leverage so that we will be harmed in the future. So, but this is a key one, but it is not the only one. And then another important point is that you can compare your CAGR, the stock's CAGR, to inflation. So let's say that and this is going to be a bad example, so it's not a realistic example, but I like in my examples to kind of boil things down and make it really, really clear. So let's say that you have a dividend income and you are living off your dividends, right? Let's say you've retired, you're living off your dividends. You end up with $1 a year in dividends. I know it's not realistic, but it helps them with the math. And then let's say that your expenses for the year are $1. So at the end of the year, you brought in $1 in dividend income. You spent $1 for expenses. So you're clean. You had zero left over, but hey, that's okay. You made it through the year. Let's say that inflation for the year was 3%. So that next year, instead of $1 in expenses, you're going to have $1.03 in expenses. If you have a company that raises their dividend by 3%, then you've really broke even with inflation. If you have a company that raised their dividend by 10%, now you're bringing in $1.10 from that particular stock versus your expenses of $1.03 with inflation. So you can see how having a higher dividend CAGR will help you outpace inflation, especially in retirement. So that's a key point for CAGR as well. There's some caveats. I think I've already mentioned that. Make sure you validate this with their cash flow statement. It's important to understand the business. Don't just look at CAGR. Look for spikes so that you will understand why, if they go up really high one particular year, it might skew the 5-year look if they got a really high or really low year. Make sure you understand that. So we got the spikes. Decide on the time frame. I think we talked about that. But regardless, be consistent with whatever time frame you pick. And can we boil this down? Yes, we can. How much does the dividend grow on an annual basis? That's really what CAGR answers in percentage terms. Always check the cash flow statement, and you use this in conjunction with other metrics. So thought I would pass that information on to you guys. That is it from a CAGR perspective. So it's good to have you guys tonight. Let's go to let's talk about some things maybe that you guys are interested in tonight. I do think I may. What do you think about this Medtronic article? Do you think it's worthwhile to invest now in Medtronic, or should we wait a little bit longer? I don't know. So I'm gonna share this screen here. Share, and it's gonna be this guy here. Okay, let's go look at Medtronic. In Simply Safe Dividends. So as we talked about, Medtronic has a dividend safety score of 99. It has a dividend yield of 3.5%. So that's actually not a bad yield. It has a slow dividend growth of this past year of just 1.5%. But let's go down and look at the CAGR information for Medtronic. Here it is right here. So they have, even though it was 1.5% this past May, they actually have gone 8% over the last 5 years and 13% over the last 20 years. So you can see how their dividend has, it looks like a straight line, but it has slowed as of recent times. They've paid a dividend and grown their dividend for 45 consecutive years. Let's look at some of their payout ratio. Their payout ratio is in the 50% area, 50% line. Their free cash flow payout ratio, you can see that they had a little bit of trouble in, I guess, the last 12 months. They were getting about 90%. 60% is what they're projecting over the next year. So that kind of helps with the story that Simply Safe Dividends is laying out here. Earnings per share looks pretty flat. The free cash flow per share is going up as we noticed. Let's look at return on invested capital is about 8%. They're not lighting it up on return on invested capital, but that would kind of make sense, right? As they are struggling with profitability through, starting with the pandemic, and it really has never come back for them. So that's we got net debt to capital. They only got 25% debt to capital. Their interest coverage ratio looks fine. So, I think, it's certainly interesting. I will add a few shares. I want it to be above 1% of my portfolio, but I'm not sure that I will add a lot, but I will add some. I may wait for it to go down a little bit. Okay, let's see what's going on in the chat. So Fast Eddie wants to know, do I follow Rob Berger? I don't think I've ever heard of Rob. Did you see his video today about his blue binder? I did not. I'll go look him up. Rob Berger. Let me write that down or I will forget because, I am retired and sometimes my memory is not what it needs to be. So Rob Berger. I mean, if he, instead of having an R at the end of his name, if he had two S's, we could be related, I guess. Let's see. It explains everything to his wife about what to do in case of his death or her death to their children. That's a fantastic idea, actually. I love that idea. So, hey, I'll check that out. I appreciate you bringing that up. Do I have anything like this? I do. It's not as detailed, I think, as what you're talking about. I don't list out in there how. Well, let me just come back for a second. I have something that I call my legacy sheet. And my legacy sheet is actually multiple pages. It lays out, what we own, anything that we might owe. It lays out how to get to that information electronically. It gives, passwords and all that kind of stuff. And all of that it's held in actually, I don't even have it electronically. I just keep it as a hard copy. And then I also have a document that lays out my investing strategy, not only for dividend stocks, but also for real estate. So I do have those types of documents. I don't know that it's as good as what he has. So that's why I'm interested to take a look at that and see if he's got any thoughts on, making that better. So, no, I appreciate that, Fascinating. That is great information. I think it's helpful for anybody because we don't know when our time is up. So it's always best to leave a legacy with our families by giving them some insight into what we were thinking and make sure that everything is taken care of. Okay, Greg, building up J&J for now. I've had Medtronic on my list, but looks like it's slowing down. Yep, that is true. Looks like it is slowing down. It was down a little bit. I won't pull the chart up, but it was down a little bit more than it is now. But yeah, it has slowed down. J&J is a great pickup, I think, at these levels. I'm not picking up J&J at this point because it's a pretty decent size of my portfolio. So I'll just kind of leave that as it is for the moment. Let's see what else we got. Yeah, so Greg says he might wait a bit on Medtronic. That's great. I think that makes sense. And but I do think I'm going to pick up a few shares just to get me up over that 1%, because I'm really kind of rethinking the way I do my portfolio. I usually will pick up a few shares in a company that I'm interested in, like Medtronic. I've actually bought Medtronic twice. It's been quite a while ago, but so I usually end up with some shares of companies. But then what happens is they run, and then I end up with just these little positions, and it's takes me more effort than it should every quarter to kind of keep up with my investments. So I'm looking at kind of changing my philosophy to say, if I'm not willing to put at least 1% of my portfolio in a company, I'm not going to invest in it. So that means I've got several companies that I have less than 1% in. You'd noticed a couple of videos ago, I sold 4 of those off. There's some that I'm going to actually raise above 1%, and Medtronic, I think, is one of those. Might be a great time to do that. Miguel, can you give your opinion on Stevanato Group? Miguel, I don't know that I've ever heard of Stevanato Group. So let's, that means my opinion is going to be worth its weight in gold, my friend. Let's see. I'll pull it up here. Let's see what I can find out. Stevanato. Oh, that's not it. Stevanato. Must have spelled that wrong too. Oh, it's an A. Stevanato. There it is. So it is. They let's see. They have a 0.22% dividend yield. They're around $26. Where are they from? It looks like they may be Italy. They're from Italy. So I think, you guys are aware that I typically don't invest in foreign companies, although I will say that Medtronic is foreign now that I say that. But I think it's Dutch. So there's not the tax issues with that the others have. Sorry about that. So I don't really know much at all about Stevanato. It looks like they were paying a nice dividend in 2020, and then it went down to 0. So, I don't know. I say 0. It's now at 5.4%, 5.4 cents per, or I'm sorry, whatever cents are in euros. It's 0.054 euros per share. So I don't know, man. That's probably a little bit too much of a gamble for me. So I think I would stay away from that one. Just for me personally, I'm not saying that everybody should stay away from it. It's just something that I'm not interested in. So we got Kevin. He said he spent the last 10 months DCAing into Johnson & Johnson. $50 each time. I was going to say $50 a share is a great. That's a great average cost. But his average cost is looks like $159. So that's actually not bad, my friend. Well done. I think in the long term, you're going to be very successful with that investment. Well done. So Thomas, we have what are your favorite sites to do your research? Seeking Alpha, Simply Safe, any that are free. Well, I will say this, Thomas. I use I use 4 sites. Can you see that 4? I use 4 apps. I call them apps, but I use 4 apps. One of those is Seeking Alpha, and the thing I like about Seeking Alpha is that it has a lot of good information that is free. So for if you're looking for some free research, Seeking Alpha, it does limit you in what it'll give you, but it does have some good information for free. So I would point you first, if you're looking for free, to go to Seeking Alpha. If it's something that you wanted to go to a premium subscription for, they do have a Black Friday deal going on. And so, it's worth looking into. Another one that I use a lot is Simply Safe Dividends. It's the one that's on the screen here. It tells me things like the payout ratio, the free cash flow payout ratio. They have a dividend safety score. I don't necessarily look at the number on that safety score, but I like to look at whether they think it's very safe, safe, borderline, unsafe, very unsafe. I like to look at it in those major categories, but it really pulls some data together for me. So that's one that I use. A third one is Morningstar. I really enjoy Morningstar's analysis of stocks. They have real people who are doing real analysis. Of course, their fair value is only as good as the people who are doing the analysis, and nobody knows the future. So who knows, whether their fair values are correct, but they're a lot more correct than mine would be. So I trust their fair values a lot. I trust their analysis a lot. And so I use Morningstar quite a bit. And then the fourth one is Quarter. I use Quarter, QUATR. That's also free. I think it's free on the phone, but I don't know about their desktop product. But Quarter, if you're looking for a way to kind of keep up with your earnings calls and events like that, Quarter is a great app to use. So if you haven't seen that one, take a look at that. I'm trying. Oh, and there is one other. Let me kind of show it to you. It is Fast Graphs. I do use Fast Graphs. You can see that I was playing around with Medtronic earlier, and this is one of the cool things. So let me back up here. Just if you've not seen Fast Graphs before, Fast Graphs, it'll tell me, hey, Medtronic closed at $79. Its historic normal PE is around 18.4. What that means is, and I've got this set on 10 years, as you can see right here, but over a 10-year period, their average PE has been around 18.4. They're currently, you can see this black line, trading at 15.15. So what does it mean if they go back roughly to what their normal PE is? So I look at forecasting calculators. I go from here to let's just go to 18, because they only have 18 and 19 and a half. So we'll just say it goes back to 18 from 15.15. You can see that that's almost 16% every year that Medtronic would grow and build your portfolio by about 16% per year. So that's not too shabby. It doesn't mean that they will get there. It just means that if they do, that's what the numbers would be. So Fast Graphs is a pretty good software tool. However, Morningstar, Simply Safe Dividends, and Fast Graphs are all paid apps. And you'd have to go to their site to see what the prices are, because I really don't remember. But I pay the annual fee for each of those. My portfolio is big enough that it supports that. It helps me save time, because it's important to me, at least at my stage of life, to be able to spend as much time as possible with family and, my grandkids and things like that. So if I'm going and pulling numbers off of financial statements, trying to calculate payout ratios, that's to me a waste of time when it's just readily available in some of these apps. So sorry to go on and on about that, but those are the apps that I use. I will mention one other one. I know this is exciting stuff, but I'm beginning to use something called Tip Ranks, and I'm testing this out, and you can see that I've got all of my portfolio in there. So that's another one that I'm using. It is also a paid app. So, anyway, that's kind of where I'm at. I'm testing tip ranks out, so hopefully that's helpful to you. Here, let me come back. Oh, there I am. Let's see. Tutomi says, "Hey Kevin, what are my plans for Christmas and New Year's?" That's a great question. I appreciate you asking that. So my plans for Christmas, we'll probably do Christmas here in Alabama, and New Year's as well. We're getting the kids to come in. I've got one kid and family in Ohio, one in Pennsylvania, one in North Carolina, and then one is actually here in Alabama. So, hopefully we can have the farm as a place where we can congregate over the Christmas and New Year's holiday. So that's kind of what we're planning. It's not anything exciting. We're not going on a trip or anything. But it is always fun. And maybe about that time, guys, I've been making some muscadine wine. We had some muscadine grapes on the property, and they had a bumper crop. So we've got all of these grapes in the freezer. I'm trying to figure out ways to use them. We've made jelly, and so now we're making wine. So hopefully around Christmas or maybe closer to the middle of January, we'll have our first batch of wine, and I'll have to let you guys know how that turns out. So I'm excited about that, actually. So anyway, appreciate the question. Yeah, that's awesome. Oh, Billy added to CMI today. That's a great time to add. I do have plenty of CMI, so I'm kind of letting it ride at the moment. But that's a great time. It is down, and I think it's going to go back up, as the economy returns. Greg says, his average is 157. I think that is on J&J. Yeah, that's his next thing is on J&J. That's a great average, man. That's really awesome. Billy bought 100 shares of KRC a few days ago. Very small position, and he doesn't plan on adding any more. But he has a large position in O and FRT as well as Vici. So that's really exciting, my friend. So welcome to the KRC club. I know my buddy Ryan Williams would also welcome you. He's a big fan of KRC. So welcome to the club. I think KRC over the long run is going to do very, very well. It's not worth, as you mentioned, it's not worth backing up the truck, but having a little piece of the portfolio in there and getting a little bit of that sweet, not only dividends that they're giving, but also that capital gains is not a bad place to be. Jim is talking about a legacy plan for his wife is to hit the reinvest all dividends. And if by some chance he dies choking on a gummy bear, just tell people he was killed by a bear and leave it at that. Hey, that's a great idea, man. We would all believe that too, Jim. But, she would have to sign in and come into the live stream and actually let us know that you were killed by a bear. So hopefully that doesn't happen. But because we do enjoy you being here in these live streams, and they are called live streams for a reason. We want you to be alive while you're in here. So, okay, we got Money Mike's Investing. Welcome to the program, my friend. Any insight on Mondelez? I've looked at them in the past, so but it's been a while. So let me kind of refresh myself on Mondelez. I think it's NDZ if my memory is right. Let's go first to, as I always do, to Simply Safe Dividends. I'm going to just type in MDZ, and it's wrong. I'll just type it in. MONDE. There it is. MDLZ. Okay, they have Simply Safe Dividends rating of 66, dividend yield of 2.38. Let's move on down to some of the fun stuff. Yeah, they're a snack food business. Looks like Latin America, North America, Asia, the Middle East, pretty much around the world. They've got biscuits and baked snacks, cookies, crackers, salted snacks. So it sounds like my kind of company. They reaffirmed the 66 on November the 16th. So their payout ratio is about 49%, which, I think is very good. They got net debt to capital at 40%, which is not too shabby. Let's look at their dividend growth. It's 12% over the last 5 years. Their latest was 10%. So that looks really good too. The thing I think that scared me away from them was this dip right here. I don't know if you can see that. It was, they, for some reason, and I did not go back to 2013 to see what happened, but their dividend dropped over in half. And then, now they're back up to 150. I think I was looking at it maybe back in here. So they had just gotten back to where they were in 2011 with the dividend. So I kind of stopped looking at them at that point. According to Simply Safe Dividends, they are reasonably valued. But let's look at some of their ratios here. They have earnings payout ratio around 50%. And cash flow is around 60-something%. So not bad at all. Look at this earnings per share. I'm going to get myself off of the screen here. I got to get, no, I'll leave me on. It's too hard. So their free cash flow is growing. They're buying back shares. Look at that. They had 1.79 billion shares in 2013. They're now down to 1.37 billion shares. That's a lot of shares, man. But they bought back a lot as well. Looks like their sales are coming back. So that's good. That has happened since I started looking at them, or since I looked at them before. Return on equity. Now let's don't look at that. Return on invested capital. 11% is not terrible. It certainly pretty much matches their weighted average cost of capital, which is real nerdy and technical, but so anyway, I think that's good. Let's see, net debt to capital is around 40%. That's good. And their interest coverage is 10.8. So, just looking at the numbers, they look actually pretty good. Money Mike, maybe I'll just call you Mike. They look pretty good, Mike. So it may be something that, I look into a little bit further. I had Pepsi and didn't really need another packaged foods company. But, since I got rid of Pepsi, it's a bit of a hole in the portfolio. So appreciate you bringing that up. And my thoughts are it looks pretty good from a numbers perspective. Let's see. Thomas, thanks. I can spend way too much time searching out the details. You are exactly right, my friend. It takes a while. I mean, if you really want to do this right, it takes a while. But if you've got these apps that can help with the numbers, you can build a process that looks at that stuff pretty quickly. Miguel, Kevin, what is your opinion on only buying stocks which have a large shareholder like founders, for example? I'm not really sure I'm following that. My opinion on only buying stocks which have a large shareholder. Maybe can you hit me with that again, Miguel? I'm not really sure what a shareholder like founders is, and it's probably just because I'm, trying to do a video and all this stuff. I'm not able to kind of get that in my head. Wow, is it El Dynamico's birthday? Happy birthday, my friend. Welcome, and thanks for joining the broadcast on your birthday. That's really meaningful. I really appreciate that. Not just anybody would do that, but you, El Dynamico, that's the way you roll. I appreciate it, my friend. I like to know who owns the company and if the owners are on the same page as us small investors and if they have skin in the game. So this is Miguel again, and I think now I understand. Okay. I think what Miguel is asking is, what's my opinion on only buying stocks that have a large section of their shares owned by insiders? I think that's what he's asking. And it's a great thing to do, but it's typically small cap companies. You don't see large cap companies like Johnson & Johnson or even Medtronic for that matter. They have so many shares out there. It is really difficult for insiders to own a large piece of that. I do like some companies that have a large insider ownership, but it's not something that's really important to me. So I will I will notice that. But what's really more important to me is what the insiders are doing. Are they buying shares? Are they selling shares? That's a key indicator to me as to what they believe about the company, and they get to see a lot of things that we don't get to see, right? So if you've got insiders selling off shares, might be worthwhile to take note of that. Or if you got insiders buying shares, like Air Products, the CEO bought a ton of shares right after the earnings, then it's important to bring that out. So those are my thoughts on that, Miguel. That's worth that, and as we used to say, that and $1.25 will get you a cup of coffee at McDonald's. I'm not sure that would even get it at this point, but you get the point. Fast Eddie, you own a farm or plantation? You are in the South. Yeah, I don't own a plantation because I'm the only worker, which really kind of sucks. But yeah, so I do own a farm. I have chickens and bees, and we are looking at next year possibly adding a head or two of cattle. I don't know that I would call it a farm. I think I would call it a homestead, but that's what we've decided to do. It was right at 1 year ago today that we closed on the farm. And so we've been here, we've moved in, we've gotten kind of comfortable with where we are. And so we're beginning to move forward with plans for the future related to this farm. So yeah, but no, it's not a plantation at all. Didn't they sell Kraft Heinz? I'm trying to think of who they is. Kraft Heinz was actually owned by Philip Morris at one time. Well, the old Philip Morris, which then became Altria Group before they spun off another company called Philip Morris, which is really confusing. And but then Kraft Heinz, Philip Morris, and Altria Group were spinoffs, I believe, of that Altria divestiture. So I think that's, unless I'm missing something. So, all right, my buddy Ryan. Kevin, what do you look for in a net debt to capital? Yeah, that's a great question, Ryan. What I look for is I want it to be no more than 50-50. So I look for companies that are getting half of their capital from debt, half of their capital from equity, because equity is much more expensive for the shareholder than debt is. And so I look for them to have a cap structure of about 50-50, no more than that. And the other thing I look for is, the net debt. If they have a bunch of cash on their balance sheet and their net debt zero, I'm okay with that. So, but that's kind of what I look for. I look, if anything's above 50%. But hey, let me show you something. This is a great question, Ryan. I'm glad you asked it, because let's flip down here and pull up Lowe's. I want to show you guys something that is important to keep in mind. I own some Lowe's shares, and you will see here on the screen that Lowe's has dividend safety of 93, dividend yield of 2.2%. You can see here, this is my holdings. It's basically 1% of my portfolio. Remember, I want to have at least 1% in any given stock. I've still got a gain of about 13.9%, so that's encouraging with as low as Lowe's has been trading. And but I got about 62.58 shares. And if I move down a bit, we see their payout ratio is really nice. But let's move on into some of the data. And so understanding the business and understanding financial statements is really important. If you own Lowe's shares or are wanting to own Lowe's shares, I want to share this with you. So you will see here, and this is why I don't trust the return on equity metric. You'll see a negative 55%. In 2022, it was a negative 500%. So why is that? What's going on with Lowe's? If we had the time, we would pull up their financial statements and I would show you what's going on. But for now, since we're running close on time, I will just tell you what's going on. They've been buying back a tremendous amount of shares. So when, as a company, when you buy back shares, you are giving cash to the market, and in exchange, they give you shares, and then you retire those shares. And as a company, they would retire those shares. And so what the entry is it would be a credit to cash. I know it's exciting accounting stuff. It would be a credit to cash and a debit to equity. So Lowe's has been buying back all of these shares, and it has reduced their equity down to I think a negative number. And so that causes them to be able to have a return on invested capital. Let me get my cursor back in the right spot. Return on invested capital of 55%, which is tremendous, but yet they have a negative return on equity. So it's important to understand the business and understand what's going on behind that business. So what do I look for in a net debt to capital? I look for about 50%. Let's see what theirs is. It looks like they don't have the last, but you can see the this is kind of interesting. So I mean, Lowe's says 94%. So 94% of their capital structure, debt to equity. So 94% is debt, 6% is equity to get 100%. That's a lot, right? And really what's going on though is that they're buying back all these shares and reducing their equity balance down. It's misleading the way that this is being portrayed here. So I wanted to share that with you. So what do I look for in net debt to capital? It's only one of the factors I look at. And if it looks out of skew like it does in Lowe's, I want to chase that down, find out what they're doing on their balance sheet, in their cash flow statement that makes it what it is. If it looks really weird, there's usually a story behind it. So hopefully that's helpful. I appreciate the question, man, because it is a great question, and it's something that we need to, as investors, get better and better at, because they share information with us, and it's important for us to look at what that is. All right, we've got Kevin. KHC is a separate entity spun off from Mo. Yeah, that's exactly what I had mentioned a little earlier. Great job. Let me go through here. Yeah, Mike is saying that Dip and Mondelez is the Kraft Foods spinoff. I'll have to look into that further. I thought Kraft Heinz was owned by Altria Group, but I could be wrong. I don't own Mondelez, so I'm not an expert on that. Dresh says, I guess we won't get any ketchup flavored Oreos anytime soon, and that might be a blessing, my friend. All right. Ramos Agree Realty. Miguel Ramos. Agree Realty has a lot of insider founder buying. I consider it a positive when founder has skin in the game. I agree, but it's not something that not a hill I'm going to die on. All right. Miguel, Sherwin-Williams. That's a great question. Sherwin-Williams, for a long time, was out of sight from my perspective. It was way overvalued. Let's kind of look at what Morningstar says about Sherwin-Williams. It's I don't own Sherwin-Williams, but I know it has come down a lot in value. Let's see here. It's trading around 275, and still it's at about a 29% premium. I mean, take that for what you will. I mean, it shows a wide economic mode is exemplary. There's a reason that people are buying it. There's a reason that they've pushed the price up that high. It is worth that for some people. Morningstar considers it a 2-star stock, which is means it's pretty high priced. Very quality company, but it's just I just can't convince myself to buy it at these levels. So even though it has come down a lot, let's take a look at. No, let's don't. We'll just leave it at that. I like them as a company, but it's just perennially just overpriced from my perspective. So I don't invest in it. ADC has a lot of insider buying. IEP has a lot of founder insider buying in the stock sucks. Yeah, that is true. That's very good, Jim. So I think with that, we're going to call it a night. It is already after 9 o'clock. I really appreciate you guys showing up for the broadcast. Be sure to hit that like button. And I know that I will be traveling for the next 2 weeks, but I'm going to try my best to have the live stream as normal on Monday night. I will be in Ohio Monday, and I will be in South Carolina the following Monday. So, if I have to move one, I may move the second one to the Tuesday. We will actually be driving to South Carolina on Monday. I'm not sure we will get there in time for me to get all set up, connected, and ready to go. But also let me know, because one of the things with these live streams was that I wanted to get your thoughts on whether we should continue them or not. I wanted to do 4 of them in the month of November. We've accomplished that goal tonight. This was our 4th one. Let me know what you think. Should I continue this process? Should I, kind of rethink that? Or, just give me your thoughts. I'd love to hear it, because really this show is about you and whether you're getting any value out of it. So, and then also if there's something I could do better, let me know that as well. I'm certainly open to that. So I appreciate you guys showing up, and love to have these conversations with you. So with that, I'm going to get off of here, and I hope you have a great evening and a great week. And I will see you in an edited video Saturday and a live stream Monday. I'll see you there.